Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back. We're going to cover all of the closing trades, no open or adjustment trades today for July 17th, which just also happens to be the anniversary for my beautiful wife and myself. 4 years strong and going and continuing, hopefully 40 plus more with her. So I want to go over all of the closing trades today. We only had two closing trades, but they were two big closers because they had a lot of margin. They were both strangles originally, and specifically UAL because UAL was a massive trade for us. And as we get close to expiration for July, we could have let this thing go another day and maybe would have gotten another $100 out of it or so, but really just didn't want to take that risk of that last day and then getting assigned on the last day. We run into a lot of risk of actually getting assigned on a lot of these contracts because they were all in the money contracts as far as where they were on either the call or put side. So we could have run the risk of actually getting assigned on a bunch of these, which would have created a huge stock position one way or the other in UAL, which we don't want to take. So at this point, we had to close out the trade, but still happy with what we did as far as adjustments at the end of the day. So let's go over UAL to begin with. And so UAL, what we did is basically close out of our entire trade with this massive custom order. And all I did was actually enter one order, and I had a lot of questions about this afterwards, but I entered one order that basically said, okay, sell all of this stuff at the exact same time for a predetermined price. And we'd actually put in about $3.90 or $13.95 in our pricing, but actually got a fill of $13.85. So that's actually where the market filled, and it filled two of these orders. So let me just break down this order for you guys so you guys can see how it goes. It's a little bit different with these custom orders. We do not do these all the time, but this is a great example of how these orders work. And once you start to understand the sequence of how these alerts go from Thinkorswim or my broker platform to you guys, it's very easy to break them down. So we went here and bought, which means that we paid money for two of these, but then you see it says 1, 2, 3, and that doesn't mean anything other than that one contract here is talking about one of the 39s, which are then related to the call side. So we bought one grouping twice, so two actual options back on the 39 calls for UAL in July. Then you can see that number 2 here, which means that we bought two of the twos, so 4 of the 43 calls for UAL. So you see how that sequence works. That 1, 2, 3 also relates to the same 39, 43, 46, also relates to call, put on this side. So it's right in order as far as the sequence that it goes in. And then finally, we bought 2 times 3 of the 46 puts. So we had 6 46 puts that we were short, so we bought back all of those as well. So that's kind of the breakdown of that alert. Again, I know that that's confusing. We don't do these maybe but once or twice a year, so this is a little bit different, but that's why I said in the alert to a lot of people, and I guess some people didn't read it, but we were totally out of UAL when we sent out this alert. And we had made an attachment or an addendum right at the end of the alert that says we are now completely out of the position, which means that you should have closed everything out. So if you haven't closed everything out of UAL, I highly suggest you do that real early in the morning tomorrow to just avoid any type of exercise or assignment risk that you might have. So at the end of the day, after all of the adjustments that we had, as far as rolling down strikes and adding strikes and all the stuff that we had with UAL, we ended up with a 284 loss overall. That's not per contract, that's not per spread, it's not per option, it's a total look at the entire portfolio because we were adding things here and there, so we usually do it on a per spread or per contract basis, but overall our loss was 284, and that's okay. I mean, I'm fairly happy with that. I mean, to be honest, with UAL, as far as where the stock was, it was a very volatile stock heading into July. We could have absolutely rolled this to August expiration, and we may continue to trade this as we have earnings coming up for UAL in just a couple weeks. But with where the stock has been and where it has gone all over the map during this month, there's no telling that it could have closed right in the middle of the range. And when we actually entered this spread, which is really the frustrating part of this, but it's part of trading, is we actually entered the spread right around here when the stock had gapped a little bit lower. So the stock gapped a little bit lower, and at the end of the day, it actually closed pretty much exactly where it was, except for all these just kind of random movements. Now, again, when we made our adjustments, this is when the stock was really testing kind of the lower boundaries of our strangle here. So we were short the 40 options, which are down here, and it was going way in the money. So we had to do something because we didn't know it was going to turn around. And so I guess that's the tough part about it, is that the strategy that we had originally would have worked had we done nothing. But if we'd done nothing and the stock didn't turn around, it would have created a massive, massive loss for our portfolio. So I'm glad that at least we got out with a 285 or 284 loss on this. That's okay, I'll take it, and we'll just kind of move on to the next one. The next trade I want to talk about is our SNDK ScanDisk options strangle for earnings in ScanDisk. Now, I had said originally in the alert, again with this one, that it was an earnings trade, so it's a little bit more risky because it's kind of a binary 1 or 2 day event that we had for SNDK, and we went ahead and sold originally the 112.99 call put strangle, so the 112 calls and the 99 puts, and took in a credit of about 165 cents or $1.65. So that moved our break-even point out $1.65 on each end, kind of really captured a very wide range for SNDK, and really captured kind of the normal standard distribution range, right? So the range that the stock may move about 68% of the time. Now, today we ended up closing out that trade, thankfully. We sent out the alert about 4 or 5 minutes after the market opened, closed it out for a 104 debit because the stock had opened up heavy down and on some heavy selling volume. So we actually closed out this trade at 104 debit, made a nice $61 profit. It was just a one lot, so very small profit on this one, but very thankful that we did that. However, I did get a lot of emails from people saying that they did not get out of this trade as quickly as we did. And I know that it moved fast, and that's just sometimes how it goes. But the stock actually ended up closing all the way down at 93.21. The stock was down almost about 13.5% today, which is a huge move and way outside of that standard deviation. So this brings up two really good points. One, you shouldn't be trading this thing large enough that this thing actually really hurts you. I mean, it's going to hurt, obviously, if you didn't get out of the trade, but I know a lot of people said that they had leveraged up to 10, 15, 20% of their portfolio in this one trade, and I've never ever suggested that anywhere in any of the stuff that I talk about. And it brings up a great example of why you should not do that, because you have a stock like this that moves outside of that normal range. So 68% of the time it's going to be between 99 and 112. And here we go. We have that stock that makes that kind of one every 5 or 6 year type move where it just moves huge after earnings, and you've levered way too much in your portfolio and it blows up your account. And all I can say is that I've never taught any of that, and I in fact preach against it constantly. So really you get what you deserve in that, right? You get too greedy, you don't really follow the basic laws of trading these options and understanding risk management, and you get what you deserve. And I'm sorry to say that, but that's the business that we're in, right? Now, for those of you who are in it that want to adjust it, what I had said before and on the membership site and through some emails to some people as well is to roll down your 112 down to 99. So by rolling down your 112 call and closing that out, it's worthless anyway, so you close that out and re-enter a position around 99 that would have given you a pretty massive credit today. So you would have had a credit of anywhere between $5 and $6, somewhere in that range. So that credit of $5 and $6 would have moved your break-even point out to somewhere around 92 on either end, give or take, and maybe like 101, 102, depending on the credit that you got. So you would have moved your break-even point out a lot by adjusting very aggressive towards the market, and that's what you have to do. We've done that before in RUT and Yahoo and Pfizer and Whole Foods as well. We've done this a lot of times before, but you have to adjust very aggressive. Now, tomorrow, if we don't see any sort of bounce in SNDK and you still have that position where you have basically a straddle, a call and a put short at 99, your best choice is to roll that strategy off into August expiration. And the reason is because you want to give yourself more time for implied volatility to come down, right? We did see a good move down in implied volatility, but still up in the 60th percentile. So that means that we've got a lot of room for implied volatility to come down. So if we go to the SNDK options here, you can see that we're definitely going to start to see some decay in these further out of the money options. But if you roll them to next month, like for example the 95s versus the 95s for July, there's about a $200 difference in the credit that you're going to get between July and August. So rolling that out, if you have the 95 options, rolling that out to August is going to get you $200 extra, which moves your break-even point $2 further for that extra time. So again, the whole idea here is to take in a lot of credit, move those break-even points out, and keep recentering the trade. So if somebody needs help on this, Obviously, feel free to continue to send in your support requests, add your comments to the website. That's the best so that everybody can see inside the membership area. And I've directed some people to add their comments, even their emails, right back to that membership area, because then everyone else can see what everyone's doing and kind of running through here. And as a community, we can all learn from that about different positions that everyone has. But right now, your best bet is to roll down that 112 option. Roll it down as close as you can for July, and if it doesn't work for July tomorrow, with the market possibly rebounding just a little bit, kind of a little dead cat bounce, then roll both of these contracts, both your call and your put, out to August. Give yourself more time and more credit to be right. So as always, I hope you guys really enjoyed these videos. I know this one was pretty quick tonight because we only had 2 closing trades to go over. But if you have any comments or questions, feel free to add them right below here. I'll get back to all of those tonight or tomorrow before the open, and happy trading.